Recording in progress.
Good morning, good evening, good afternoon, and welcome to the 2022 Master Trader Program with Mark Minervini. My name is Bob Weissman. I'm your moderator for the weekend and do want to welcome you to day 3 of the event. Today's curriculum will be approximately 3 hours, 20 minutes or so, and then we will have a live question and answer session with Mark and Mark as well. Any questions you do have regarding the curriculum from the first weekend, day 1 and 2, as well as today, can be emailed to me at bob@minervini.com. Please do not type questions into the chat box because they get lost very quickly and will not be able to be recovered to be asked. Today's attendance, of course, is strictly prohibiting any audio or video recordings and sharing of the information you are learning from Mark Minervini here today. Our event is sponsored by MarketSmith, by Investors Business Daily exclusively. They are our official sponsor and brought to you by Minervini Private Access. So today we are going to start with failure reset. This is page 261 of technically volume 1. It's the last part of volume 1 that Mark still has to get through before we get into volume 2. And with that said, I will share with you, we'll have a few breaks after each of the sections today. So again, I believe we'll have 3 breaks during the curriculum portion. We'll take a break after the curriculum is over, and then we'll get started with the questions and answers after that. Also, as a reminder, a replay of today's session will be at 6 p.m. Eastern Time, New York time. It is with the exact same material from this morning that will be shown again this evening. And also the same links and logon information is what you'll be using for all the sessions. Again, some people have asked me for new links. It'll be the same ones. If you're here already, of course, you're already in the room, but for tomorrow, day 4, as well as the live training day on Monday, November 21st, there will be additional questions and answers available on Monday during the live training day. But tomorrow, day 4 of the curriculum is purely curriculum, as it's an entire day event for that. Again, entire day meaning about 5 hours or so. We'll get more details of that tomorrow. But today's curriculum for day 3 starts on page 261. And with that said, let's get started with Mark and Mark.
Okay, everyone, welcome back. Day 3, 2022 Master Trader Program. Not seeing myself up in the video here, so I hope that I am actually recording. Can you see me, Mark?
I sure do.
Okay, great. Hope everyone else sees me. Real quick, our sponsor is MarketSmith, and just want to remind everyone once again, on live trading day, we'll be doing a tutorial on MarketSmith. We'll have somebody here from MarketSmith. I think it's Scott St. Clair, and we'll be going over the MarketSmith product and how we use it. So just wanted to quickly point that out. Let's see here. So right now, we're going to talk about something that we call a failure reset, and that is where when you get into these chart patterns, these VCP patterns, sometimes you'll be early, and particularly this is a really good time to talk about this because when you're in a bear market, you're in a correction, especially when you're in a large correction or a large bear market, you can get bear market rallies, you can get false signals, if you will, and sometimes you'll have these BCP patterns set up and they get tight on the right side only to find out that they needed more work and that it was just the beginning of what needed to be a longer or have more contractions or even sometimes some widening of the volatility and then a retightening. I'm going to show you that right here. So again, you start seeing these patterns, you're doing your screening, or maybe using MarketSmith, and you start seeing these patterns show up, we tend to get really excited when we start to see a bunch of VCP setting up because that's a potential, those are opportunities. And then when you set up that pivot right there, that tightest point in the right side that we refer to as the pivot, if you take out the low in that pivot, and sometimes you can break out and then you reverse and take it out, and sometimes you don't break out at all in a really weak market, we call that a pivot failure. And then what that does is that sort of reestablishes the count. So if you were to, let's just say this was 20%, this was 10%, and this was 5%, now it comes and takes that out. Well, maybe this is now 8 or 9%. However, as long as this is this pullback here is still in that single digit, you're still tightening up enough to this to be considered for purchase if it should turn around and then break out from there. So you have to do the math. You have to, it's real important that you're cognizant of the percentage declines and know exactly what's going on in that tightest portion. There's another thing that I forgot to point out before, and I want to I want to tell you about this right now, and that is that generally what we find is that when you get these pullbacks and these contractions, they usually they have themselves, and not always, but sometimes it's 1/3, 1/2. But generally speaking, you'll see like the first pullback might be 27%, the next one 16, 17, 18, the next one is maybe 8 or 10. They're usually about half of the previous decline, give or take. So that's just something to be aware of as you're watching this. They don't have to be, though. Okay, you can have, if this was a 10% decline and this was an 8 or 9, that would be, of course, a lot more than half of the previous decline, and that would still be fine. So what'll happen is a lot of times, and again, like I said, in a bear market, we'll have where you have some rallies off the lows, and sometimes you'll get a setup and the market will either start rallying, and they'll get some stocks setting up and they'll rally, they'll break out, or a few stocks will set up. You'll see a handful of stocks setting up, and then as the market goes to lower lows, the stock will experience a pivot failure, and it'll take out that low. But then when the market turns back up, you'll have these stocks will start to break out. And the main thing is you want to stay with the count, okay, and just keep making sure that that right side is tighter than the previous pullbacks, and that it's in that single digit range. Because once you get outside, you start getting to 12, 15%, 20%. That's just too much. That's too much volatility. It's too much risk. Now, and Mark, of course, this is something that you know a lot about, and you tend to, I've seen over the years, we call this a failure reset. You tend to play a lot of these failure resets. What's the trick to, spotting these things and then sticking with them and keeping that discipline of not getting, discouraged if those initial setups don't pan out?
Yeah, I think part of it is back to the point we talked about being weak holders. You want to think like a weak holder. And so, when you look at, this is obviously the hypothetical, but when you look at that sort of little pivot leakage, that often knocks out a lot of weak holders, myself included, or Mark and myself will sometimes get knocked out of a stock, but you don't just give up on the name. Now you don't run right back in and buy it. And we'll get into the examples of how this works, but often that subsequent setup is even better because you've knocked out previous weak hands. Now you may have been a part of that shakeout, that we talk about, but that's okay. Because if the name comes back, it potentially shows that it is under institutional accumulation. Our timing might just been a little bit early.
Yeah, and what happens is as the stock goes through these iterations, you can actually get a much improved setup that takes a little bit more time, and those shakeouts that, just like Mark said, that shakes you out. You're a weak holder. It's also shaking out other weak holders. And that is, once again, letting the stock go through that natural progression of wringing out that water. Once again, wringing out that supply. So sometimes, excuse me, sometimes you come down and you really get volatile, and it takes another tightening, and you might have to go through another tightening. And then from there, if you were, saying this is a 1, 2, 3 T, and now it takes out those lows, well, now it would be 1, 2, 3. And some people have said that this is sort of like Elliott wave. Not really. It's really nothing like Elliott wave. It's simply just measuring the percentages and then looking for the tightenings to culminate to where on the right side, on the very right side, there's symmetry and there's enough tightness in price that you're not taking too much risk. And when we say taking too much risk, below that pivot point, below the base, those are the areas that should hold. Once the stock breaks out, those areas in a good market, and if the timing is right, you get everything right, those areas usually hold. So it's abnormal for the stock to get below those levels. So we want those levels to be mathematically acceptable. So these are the technical levels that we would maybe put our stops, but they're still within the confines of the prevailing math that we need. And so let me show you another. You can also get where maybe you have a larger correction, a much larger correction in the market, and you get a bunch of setups. We've seen this before where everything looks really good, and then it comes crashing down, and the market needs another big leg down, and it washes all the boats. Takes all boats with them, and now you come off and you undercut the lows in the base. That sometimes takes a lot longer to set a larger base, and then you have your other techniques. Now you might start looking for low cheats or cheats, and then it'll build a handle later on. So that's why we have these various points and levels to get on, like they showed you, the low cheat, the handle. That the reason why we have all these different levels is because it's very unlikely that a stock could set up in a way where it comes out of a base and it's not going to at least give you either a pivot point breaking out to new highs, a low cheat, a cheat. Somewhere in that base you're going to get one of these or all of these setups, and that's the goal, is to have enough tools or tactics in your tool bag that you'll be able to get on board before the stock takes off. Now, I mentioned that almost all the stocks that I'm showing you here, a pretty good portion of them, up 95% of them, are all stocks that I traded. Doesn't mean that I traded them all successfully. This happens to be one that I traded unsuccessfully and turned out to be where I made the error of not re-entering on what we call a failure reset. So there's two kinds of resets. There's a failure reset, a failure pivot reset, and there's a failure base reset. The failure pivot reset is when you undercut the pivot, but not that much damage has been done. So you could reset pretty quickly, and sometimes you'll just get another little tightening. And this was, of course, Craft Brewers. I bought it right here, and it had this it squatted on the breakout and then came back in, and I actually got knocked out of it. But then shortly after, it was just a couple days later, it tightened up. And like I said before, it can improve. This was actually an improved setup because now you've shaken out more supply and you've tightened up really, really nice here. Look at the volume. It comes way down, and then you can see you got the 1-2 punch. You got the low volume and then a huge volume coming out, relatively huge volume at least, coming out in a really big breakout. And if you take a look here, one of the reasons why I studied this one is because I got knocked out of it. I missed the reset, and this is what happened in 26 days. I was standing on the launch pad watching the rocket from the ground and not enjoying the ride. So I you should always study the stocks that you make mistakes on, turn out to be big winners. Study them, find out, could you have gotten on board at some other point? So the failure reset is something that that we use, and it can happen sometimes in tumultuous environments where, and again, this could be a company that the earnings, just because the stock goes down 5%, 6%, 8%, that doesn't mean that the company all of a sudden is doing poorly and they're not earning money and the business isn't doing well. But see, we have to manage, and why don't you talk about this, Mark? Why is it that if the company's doing so well and we see the earnings and everything's great, then why would we sell if the stock just went down a little bit? Why not buy more or just hold the stock and go through that? Why sell it 7 or 8%? Why would we cut our loss?
Well, I mean, in terms of, are we talking on risk protection mode?
Yeah. Why would?
Yeah. Well, the short answer is risk of ruin, of course. We're never let a losing trade turn into an investment. That's one of the worst things. But look, the reality is, like we showed in a lot of these previous examples, how many of these topped while the story still looked great, and the earnings were, they might have still been triple digit even. But it's already been priced in because the market is, again, it's discounting the future. So we don't, I've heard Mark say this many times, but every 50% decline starts as a 5% pullback. And we have the humility, in my view, to say we don't know what the future is going to bring. But we know, your first loss or your best loss is your first loss. And the only way to avoid big losses is to take them when they're small.
Right. We don't have a crystal ball. We don't know. Now it's 5. If you don't sell it at 5 or 6 or 7 or 8%, well, where are you going to sell it?
By the way, I want to add though, just to this slide, because it's ironic. This was right before the very first Master Trader program. This was 2010, because I traded this as well. And I remember there weren't too many of us, and Mark showed the slide and he said, this name, stopped me out. And then I made an error, meaning it set back up and I didn't jump back in. And I remember, I don't even know if you'd termed it the failure reset yet. I wasn't even sure, but I remember writing down saying, this is how you get back in an aim. Making the notes to say, because what often folks do, they get stopped out and then they throw the name off the list. And that's to my point before. Don't, some pivot leakage and that type of thing. It doesn't mean you take it off your list. And this set back up. And I was standing on the launching pad with him because I didn't know that this was a technique, Then years later, it was something, again, you just add another tool to your toolbox to say, okay, if the pivot shakes out, but then it retightens, and see how nice the volume comes right back. It shook us out and then took off without us.
Was this all the way back in 2010?
This was 2010. I remember it well.
We don't have the year here, but I didn't remember it was that far back. And let's look at another one here. And again, we don't have a crystal ball. Risk has to be managed in real time. With the benefit of hindsight, yes, hey, we should have held that, but we don't know that in real time. So in real time, we've got to protect ourselves. And the whole key is to keep the losses smaller than the gains. The only way to avoid a big loss is to take a small loss. There is no other way. I've been doing this for 40 years. I have not figured out another way. If you know another way, feel free to tell me. I'd love to hear it, but I can tell you.
To add one more thing too, Mark, I don't know if you remember, because you and I did an interview earlier this year with Jared Dillian, and he asked us, what do you do when you get stopped out of a stock and then it sets up and breaks back out? And either you or me, I can't remember, one of us asked him, well, do you think the stock knows you that it stopped you out already? Because some people act that way, meaning, well, this stock stopped me out. It doesn't like me. That's precisely how amateurs think. The stock doesn't know who any of us are. And the idea is, if it sets back up again, and we're talking about supply and demand, this YY is a perfect example. It retightens, actually at a little bit of a higher price, which I think is even better, and then blasts off.
Yeah, well, I remember that conversation, and I think my answer was, let me ask you a question. If you lost with a pair of aces, would you not play aces the next time you got them dealt to you? And he said, of course I would play them. That's exactly right. So it's the same thing. It doesn't change the probabilities. As a matter of fact, it can improve them. The fact that you got shaken out, a lot of other people got shaken out. And once again, right back to that towel, you've just wrung out more supply. Okay, so keep that in mind. So here, just a couple examples. I just want you to see the concept here, because this is going to happen less than breakouts that just go or just fail. But you will get periods where you get resets, and you'll get situations where you get resets, and you want to have a reentry mechanism. Part of your plan should have a reentry mechanism as long as the stock meets the criteria. So again, this is one that, big base tries to come out here. It's a little short here, doesn't really drift back much, so it gets a little shakeout. You get that pivot failure, but it just was a little early and needed more time. There's another one here. Oh, actually, this is actually where it's set up again. It's the same stock. So it came here and then it did a similar type thing right here as it set up another base, and see, it came out, and then this time it didn't actually outright fail. It just squatted and pulled back a little bit. That's another thing that we should talk about a little bit. When you get a stock that squats, it comes out. We call it a squat. It's just when it reverses and it sits in sometimes the mid or a lower third of the range. Sometimes it sits all the way at the low of the day, which is more ominous, of course. But a lot of times a stock will break out. It'll come out of these bases and it'll break out, and then it'll pull back. You might even put you at a small loss, and it'll squat. Generally, I'm not selling on that. That's not a violation. I'm going to stick with my original stop. If, let's say, I went in there and my stop was 8%, I'm going to stick with that, because I've already decided that that's the amount of risk that I want to take. And that one day, unless it was a huge range and it maybe engulfed the whole pivot and you had a pivot failure and it was more than just a squat, it was actually a big reversal that would take a lot of price action to get above it. Maybe it goes up 15% that day, it comes all the way back down, closes on the low. that would be one I'd probably I'd take some off or I'd sell it. But just normal stock popping its head out and then coming back a bit, what will generally happen is you'll get what we call a reversal recovery. Very often, half the time, the stock will just pause another few days, and then you'll get that follow through buying. And that's what we were talking about earlier with the confirmations. Look for subsequent days. It might not happen on that initial day. It might take a couple days before the volume comes in and the stock starts following through.
Just to point out too in that last chart, Mark, you see how you mentioned it briefly, but you see how similar those two bases look to each other. I mean, those are just like they rhyme. They're almost perfect examples of how the stock runs up on volume, and then as it's putting in that base, the volume just starts drying up, and it does it one right after the other. That is exactly a picture of the stock going through that process we're talking about, of the strong hands slowly accumulating as that stock is pulling back. The institutions are stepping up and taking out all the weak hands until it dries up and then moves higher.
Yes, absolutely. So in this instance here, you can see pretty strong, quick shakeout here, and a gap has a decent close, but then comes right back and tightens up. See, it tightens up right here. And this is actually, and this right here, this breakout attempt, sometimes what will happen is the breakout will happen. And in hindsight, you'll look and you go, that really wasn't that great of a setup. And when you see it in contrast to the newly tightened right side, you'll see that it was just part of the process, and that you got it maybe a little bit wrong. It was wedging up a bit here where you didn't really pull back and create a shakeout. Shakeouts are important. When you shake out lows and you shake out pivots, you undercut previous lows. That's where a lot of traders will have stops. So as you undercut those lows, that's the part of the process of taking out that supply and taking out those weak hands. Remember, we want all the weak hands to be eliminated in the stock, and we want to be the last weak hand. That's the real key to this thing, is that you time it so it's really, really tight, the volume's really low, and that will give you some insurance that you are, if not the last weak hand, you're very close to being the last weak hand, and that's when the stock can really take off.
Mark, is this a good time too to talk about how that shakeout came right back into the range? Within 2 days, you were right back in there.
Yeah, sure. Let's talk about it.
I just think that's a good, sometimes people ask, it'll shake out a low, but then the stock will stay down there near the lows, and people will say, is this a shakeout? What you want to see is the stock come down and then it gets bid right back up, meaning, that somebody is down there with an appetite for those shares, and then it comes right back in the range.
Right. That gives you an indication that it truly was a shakeout where weak hands just got, maybe there was some panic selling, some retail selling, and that institutional buying just gobbled it up, and the stock came right back once it got those weak hands out. The quicker it comes back once it shakes out the low, the better. If you get a nice close, and that's where we were looking before. We're looking at, we want to see demand. Remember, I showed you how I want to see demand coming off the lows and up that right side. Very often that'll come after you shake out a low. And that can also happen within that right side where you're developing the pivot. But when you compare this breakout attempt right here to where it reset, this to the astute or keen eye that knows how to decipher these things, this is a much better. And I think just as what you've learned so far, you can see that this is a much better formed and really nice tight pivot right here versus this right here, which didn't really spend much time tightening up. Let's take a look now on the failure reset. Like I said, you have the pivot reset and you also have the base reset. The base reset is when you set up and then it fails, but it not only takes out the pivot low, it takes out the base low. So now you've had a full-blown base failure. And what will happen in this scenario, if you do reset, it's going to take longer. You have to think of when a stock has a break, if it comes down, the more it fails, the more it breaks, the more it takes out key levels or takes out lows in the base and so forth. The worse that break is, the more it goes down. It's like an athlete that has a broken leg versus if you have a sprain. So if you were to undercut the pivot, that's like a sprain. Okay, maybe a sprained ankle. You can recover from that a lot quicker. The stock can then tighten up a little bit, and within days, it could be back in viable position. However, you take out the lows of a big base. Base is formed over 26 weeks. Now you take out the lows, and there's this big volatility. That's not going to be viable as far as the criteria that we're looking for that tight price, because now all this supply came in and it would just be too much volatility. It's going to take longer. So in this case here, I bought if you remember, I showed you where I bought Dick's Sporting Goods. Well, I was actually watching this right here, where it was setting up perfectly. This was setting up really nicely and getting nice and tight here on the right side, but it never broke out. It never broke out of the pivot. What happened was it set up right into, this is the market right here. This is the S&P 500. The market started rolling over right as it set up. The market rolled over and the market took it down. But right away, if this stock came ripping back, it took out the low of the base, and just like Mark said, you get that good close, and with just a few days later, it comes ripping back up on a huge gap and right off the lows. And now the stock market index, the S&P, went to a lower low here. And now it's actually divergent. Look at the relative strength line. See, the relative strength line is going up now because now it's dramatically outperforming the market. And right here within this base building process here, where you're starting to build that right side of the VCP, the relative strength line, look, has already gone into new high ground. And then it went into new high ground again, but the stock hasn't yet broken out. And then it tightens up even more and it gets really tight. And now you're setting up for the 1-2 punch right here. Look at the volume, comes way down and then bang out, and here comes the big volume again. This is not a coincidence. This happens over and over and over. You just have to learn to be able to spot this under the right conditions, and you'll be able to take advantage of it. Let's show you here. So I guess I was supposed to go through this, and I just explained it all on one chart, but you can see here the market comes off, stock comes off. Next chart. And now that initial little setup is just part of a larger VCP. Okay, so again, you might be early. Check the earnings, see if the stock is still, if it's got all the characteristics, and stay with it. If it comes ripping back, the relative strength line is moving up. You have all the good numbers, then fine. If it sets up, then you go back in the stock. Let's take a look at another one here. Elan, I showed you this before. This is a stock that I bought in 1991, coming off the 1990 bear market. Again, it was setting up right here. It actually got my eye over here, but during this period right here, from here to here, you were in a bear market, right? And the market actually bottomed right here, and the stock went a bit lower even after the market bottomed. So now the market is, by the Dow or the S&P, was down 23% during this period, and the stock held up pretty good. But finally, the weight of the market, whatever, got a hold of it. It undercut the lows, but see, it came ripping right back. And again, I had already been watching it over here, and I did not buy it. And then when it came ripping back here and it really got tight, I started watching it here. And then when it tightened up like right here, really, really tight, that's where it really got my attention. Look at the volume. Volume comes way, way down, and you get this nice tight price. And I bought it right here, coming right out on that day. Let's see another one. Baidu. So sometimes you'll get V-shaped. V-shaped isn't as good as U-shaped because, again, it doesn't give the stock enough time to go through that process of wringing the towel, getting the water out of the towel, getting the supply out. So what will happen is you'll come off, especially if the V-shape is very deep. You come off 50% and then you come straight back up. You're coming right into those trapped buyers, and you're coming right off the lows and giving the bottom fishers very quick profits. So you're gonna intersect with both of that selling, and that's what happened here. So it had to bring the stock down again. Now you have a more U-shaped, or you have more time, right? And now it's able to go through that process. You shake out the low, right? That knocks out a lot of weak hands, and now you come up the right side and you start forming those tighter buy points. You get a cheat and you get a handle here, and so you reset the base. This is a base failure, then a reset. One more here. So this is Chef, and you can see here, this is actually absolutely perfect. This is set up perfect. Comes out and it's acting perfect. Just like we talked about confirmations, violations, we got, let's see, 1, 2, 3 days up out of 4, 5, 6, like 7 out of maybe 7 out of 8 days or so, or 6 out of 8 days. Everything's acting perfectly fine. Now it comes in, and this isn't looking so natural anymore, right? You probably would have got stopped out at break even, or maybe even it hit your stop. You're knocked out of the stock.